Hello everyone, how to find good dividend stocks. In this video, we are going to talk about a few different ways to put stocks on your radar. A relatively safe way, a risky way, and then a good way in which you are the expert. And no, I'm not talking about your political opinions and beliefs. You are not the expert, good sir. Jokes aside, some people online will just say invest in an ETF or index fund and call it a day. However, that's not for everyone. Some of us want to try and beat the market. To do that, it takes dividend winners in a portfolio and a side of time. Lady luck isn't even necessary if you select the right winners, like picking McDonald's over Burger King, picking Costco over BJ's, picking your nose over your belly button. Winners win, but I digress. So method number one of finding good dividend stocks, the common sense approach. A good place to start is by looking at companies filtered by largest market caps, as you see on your screen, like Microsoft, Apple, Nvidia, Berkshire Hathaway, etc. These are the biggest companies by valuation in the stock market, and usually for a good reason. Not all, but most are solid and wonderful companies, as you can see and recognize. Visa, Broadcom, JP Morgan Chase, Walmart. Another way to do this is to go through the top holdings of VU one by one until you come across a business that you recognize and understand. Then, and only then, do a deep dive and analyze it to see if it's worthy of being included in your portfolio. Why look at the holdings of VU? Because it's an index fund of the S&P 500. And in general, they tend to weed out the losers, which makes searching for a winner slightly easier. Losers tend not to meet the qualifications to be included into the S&P 500. Think of this as like the NFL draft. To make it into the S&P 500, the company is usually elite, runs a 4.4 40-yard dash, and play D1 ball at Georgia or USC. Sometimes a bad company does slip through the cracks like Johnny Manziel or Jamarcus Russell, but statistically there are more winners than losers in VU.
Hey, these companies aren't cheap at all. Some of them look expensive.
Well, wouldn't you agree that sometimes it's best to pay a premium for a good product? They are predictable, good dividend growers, and have a spectacular history of performance. The best part is, premium price stocks usually have market-beating returns. Not always, but since the age of the internet, this has been a fact. I'll be honest with you, this isn't financial advice, but sometimes the cheapest stocks are cheap for a reason. I can make a full 20-minute video explaining why cheap stocks are cheap. In short, the company could be constantly issuing more shares and diluting the shareholders. The company could be falling short in their revenue estimates, or they could have a lot of risk and uncertainty surrounding them. Think of it as making an important purchase in life. When you buy a winter coat, do you buy the cheapest one you can find made with material that falls apart within 8 weeks from AliExpress? Or do you look for the best jacket made with premium materials that can last a decade or even more? On a side note, growing up, I was so poor, I didn't even have a jacket until I entered high school. Little me would have loved to own that cheap jacket that you see on the right. Thanks for listening to my sob story and TED Talk. Don't forget to click like and subscribe. Anyways, looping back to the whole "the stock is too expensive" argument, the best case scenario is to find a premium company that is on a short-term dip. I consider opportunities like that as buying premium on a discount. In other words, this is when we use the label undervalued. They don't happen often, but when they do, I throw all my cash into the stock as if I'm the Washington Commanders this past NFL season. Seems like all they did was throw the ball because their run game was lacking. Anywho, as a dividend growth investor, we want to do our best to buy into a company when they are undervalued, not when they are overvalued. To do that, you got to find the intrinsic value of a company and understand your acceptable buy price. I talk more about that in my individual stock analysis videos. To sum it up, bad companies with a cheap stock price will hurt more than the stomach flu. Good companies with a premium price will take patience, but you can still buy them at the right price. The next method of finding good dividend stocks. Did you know you have an advantage over Wall Street? Listen up, because this method of finding good dividend companies is really important. Peter Lynch, this guy right here on the left, he's a legendary investor who published a book titled One Up on Wall Street. And let me give you the shortest summary on what it's all about. The individual investor, the average person, aka you, can actually beat the pros on Wall Street. Reason being, the professional investor on Wall Street, they have to cater to clients and various stakeholders, which means pulling back money during bear markets to conserve capital, aka their clients' money. Making a conservative rate of return is the name of the game. Whereas the amateur investor investor only has one stakeholder, himself. They can pile money in when the markets are fearful and go for aggressive return rates. More importantly, the individual investor is a contributing member of an industry. As a result, the individual investor knows what is good and what is bad. If you are a truck driver, you know the ins and outs of what companies are excellent and which companies you interact with that are a hot mess, late to their shipment hauls, managers incompetent, facilities being disorganized, and whatnot. If you are a nurse, you come across various products and services daily in the hospital or clinic that make your life easier, but also for the patients. You know what good looks like. Chances are, if it's a great product, the company is usually good as well. If you work in retail, you know what your company and business is like. It does not matter if you are the most entry-level person or the branch manager. You know your company more than Wall Street does. If it's efficient, optimized, and squared away, once again, chances are it's a good company worth looking into. Use your industry experience to research the companies you know, the good brands that make your working life better. The guys on Wall Street are in their suits and ties reading financial statements all day. But do they actually know the industry ins and outs like you do on the ground level? Do they actually know the experience in the real working world? Absolutely not. A common person like you and me have a totally different experience in life than those on Wall Street, especially if you have years of experience under your belt. Financial numbers can only paint a partial picture, and honestly, it does not even have to be your career that makes you an expert of certain industries or companies. It could even be your hobby or passion. Maybe you're an avid gamer that knows a lot about games and about Xbox or PlayStation. Maybe you run marathons for fun a few times a year. I don't know why you would. You're probably the type of person to run a 5K after Thanksgiving. You know which shoes and products all the runners flock to. I absolutely hate running, more than I hate sesame seeds being in every Asian dish when it's made by non-Asians. Leave the sesame seeds out. Maybe you're a meathead and you lift weights and you know which equipment, supplement companies, and gyms are good. Even if you don't lift weights, maybe you're all about that van life and you have a Planet Fitness membership to shower and scrub your smelly booty hole. Personally, I love Domino's Pizza, and that's what made me jump down the rabbit hole of researching the company. Turns out, not only do they make a solid pie, but their business operations and franchise model print cash without disappointment. If you watch some of my other videos, then you know that I have a soft spot in my heart for Domino's. Best pizza ever. Case in point, just be naturally curious. If you visit any random Chipotle in any major city at 6 p.m., there will be no less than 50 people in there. Chipotle makes a great burrito, and that alone could be a compelling reason to research the company. And when you do research about Chipotle, you quickly find out it indeed is a great company. Unfortunately, they don't pay a dividend yet, but my best guess is that in the next 5 years or so, they're going to do a stock split and introduce a dividend. That's a hot take, I know. So to sum it up, ask yourself the question, which products or services do you use on a daily basis? Brands you enjoy or improve your quality of life? This is your one-up on Wall Street. Maybe it's YouTube, then research Google. Maybe it's KitchenAid appliances, then research Whirlpool. Maybe it's Amazon Prime and all the shows you binge watch, then research Amazon. Worst case scenario, you do your homework and the company turns out to have bad finances and a shaky dividend? No worries. Move on to the next company. You're not forced to invest in a bad company. And at least you can say to yourself, you dodged a bullet. Like that one time your grandma decided to cook something up for everyone, but you already ate before showing up to the family gathering. Everybody got a case of the wet poops except for you. I got food poisoning back in 2021, and it was one of the worst experiences of my life. Well, what about if you find a company you think is worth your attention and investigation? Then, what metrics should you consider? Watch my video on what checklist I go through before considering any dividend stock. And no, I don't care about the price or dividend yield. My answers will surprise you. Just like how people are usually shocked when they find out I'm not a very good electrician. Now, I'm going to share with you a high risk, high reward method. This strategy requires you to be knowledgeable as to when companies report their quarterly performances. You can find that information on earningswhispers.com. Earnings reports are when a company publishes their quarterly performance in terms of finances, revenue, and profit. This is also an opportunity for the company to be transparent and revise their guidance. Honest CEOs are rare, and it's better to hear hear bad news up front than it is to be hit blindside. Let me tell you that. Sometimes a company does well and goes up in value. Other times, well, a company faces a slight problem and the stock market punishes them harshly. These days, especially when a company slips up, it's not uncommon for them to drop 15% in a single trading day. This usually results in the company reaching a new 52-week low price. From evaluating stocks near their 52-week low, you can assess whether it is like catching a falling knife or come to the conclusion that the company is solid and the market is unfairly selling out and overreacting. With that said, I want to emphasize that a 52-week low does not mean the stock is at a great buying opportunity. A 52-week low might mean the investor sentiment on the company is bearish, which means if you jump in, the price could go down further and further. It's also a risk because you're wishing and hoping for a turnaround story for the stock to rebound, which may never come. One example is if you bought Cisco when it was around $77 back in 2000. The company trades for about $52 today. If the company has a rock solid balance sheet, steady free cash flow, and is facing a temporary problem, then it's up to you whether that risk reward ratio is good. One of my most favorite types of places to eat out at are the local Chinese buffet restaurants. My goodness, I can usually put down 3 to 4 plates. Sometimes I try to gamble by stuffing my face with more lo mein, sweet and sour pork, and dim sum to the point where the button on my pants can pop off. Or I slip into a food coma for the rest of the afternoon. It's a fine line between 3 plates and 4 plates. The risk-reward ratio. Talking about risk-reward, I'll be honest, once a day I check Yahoo Day Losers, which you can see right here, Yahoo Finance Screeners, and from there I take a look at which companies have dropped the most for that specific day. And when I see a good company or brand I recognize, I begin to research to see what happened with them. But you gotta be careful here because a lot of the companies hitting their 52-week lows tend to be crappy, ugly, disgusting value traps. On the flip side, every so often, I'll find an undervalued gem. It's how I found Realty Income Corporation, Texas Roadhouse, and Crown Castle last year. The hard part is making an educated guess as to when a stock will stop falling and finally stabilize in their price. Let me tell you this right now. The worst feeling is not when you got dumped for the first time. The worst feeling is when you jump into a stock and day after day, the price keeps falling. So this takes practice for sure. Kind of like if you've ever tried to sell your car before, you have a number in mind after getting a trade-in value estimation, but life gets busy, so you couldn't sell it. Then the value of your car drops by 30% in a matter of weeks. It's a pretty bad feeling. Yes, that happened to me. It was one of my most favorite cars ever, but I had to let it go. I ride a bicycle now as a 30-something-year-old, and no, it's not because of a DUI or anything. I got a bicycle so I can get my cardio in during my daily commutes. One of the best decisions I ever made. And if you made it to this point in the video, well, on this channel, I'll be sharing my experiences and thoughts on dividend companies. From time to time, I might be wrong about the intrinsic value and future of a dividend company, but in my defense, for the most part, I have a specific taste. I like a certain type of dividend stock, one that is a dividend compounder with cheese. Ba-dum-ts. And when I find them, I'll make a video about them because I like sharing my discoveries with people, especially if I believe the company is a winner in the stock market. If the company is a loser, I'll still make a video about them and specify why they are disgusting, repulsive, and hideous. Most likely how my exes describe me. Anyways, I hope that helps in your quest of finding new and good dividend-paying stocks. Dividend compounders with cheese, signing off. By the way, my real name is Amos. Stay safe, everyone. Talk to you next time.